Right now, Wall Street is brutally punishing one of the most consistent software compounders on the planet. They've violently slashed its valuation multiple, completely ignoring a massive, highly lucrative AI pivot that is hiding right in plain sight. We're talking about a company that is quietly becoming the central nervous system for the Fortune 500, tying together completely disconnected databases and fractured operations into one single seamless workflow. Yet for some reason, the market is treating them like their core business model is about to be totally wiped out. So what is the real story here? Just look at this valuation gap. They are currently trading at 20 to 23 times forward earnings. During that sweeping software sell-off earlier in 2026, you saw the market aggressively rotate capital out of enterprise software and dump it straight into AI hardware. ServiceNow saw its forward PE ratio absolutely collapse, dropping from a historical premium of over 60x all the way down to the low 20s. But here is the glaring disconnect, right? While the market was busy pricing in this fundamental deterioration, the underlying business just posted a massive 24% top-line growth, and they quietly crossed a historic $1 billion annual contract value milestone specifically for their AI products. So we have to ask, is Wall Street fundamentally mispricing this entire AI pivot, or do they actually see a terminal threat that the bulls are just completely blind to? Let's break down the actual mechanics of how this business works.
Section 1. The Orchestration Engine, or the AI Control Tower. Now, to understand exactly why that massive valuation gap exists, we first need to look at how ServiceNow actually functions at a structural level. Because this isn't just another localized software app. It's what the industry calls a platform of platforms. It's an orchestration engine. Picture a massive multinational corporation. Right now, they're plagued by all these fragmented legacy systems. You've got HR over in Workday, finance is crunching their numbers in SAP, and customer data is trapped inside Salesforce. Basically, they're isolated databases that just don't talk to each other. Well, ServiceNow sits directly on top of all that operational chaos. It gives these companies a single unified interface that automates incredibly complex digital workflows across IT, HR, customer service, you name it. It essentially takes all those outdated manual emails and unstructured requests and turns them into automated, auditable processes. It is literally changing how major corporations operate.
And that brilliant architecture feeds a frankly incredible revenue engine. I mean, an overwhelming 97% of their revenue comes directly from highly predictable, multi-year subscription agreements. Only about 3% comes from professional services and education, which really just exists to help customers set up those initial complex integrations. What this means is that once ServiceNow lands a Fortune 500 client or maybe a massive federal agency, they execute this relentless land and expand strategy. They get embedded into one single department, they prove their value, and then they spread like wildfire across the entire organization, locking in these compounding, reoccurring cash flows. They aren't starting from scratch every quarter trying to hustle for one-off sales. But the absolutely crucial point here is the massive economic moat protecting those subscriptions. Think about it. Once a global enterprise standardizes all its daily operations and builds thousands of custom workflows onto the Now platform, the physical risk and the capital cost of ripping all that out to move to a competitor is just exceptionally high. That deep structural integration is exactly why they boast a staggering 98% renewal rate. It's wild. And unlike legacy competitors like BMC Software, who tried to grow by just cobbling together a bunch of mismatched acquisitions into this confusing backend, ServiceNow built its core platform on one single unified codebase. Plus, they are heavily protected by network effects. Global system integrators, think Accenture, IBM, EY, they've built these massive, highly lucrative consulting divisions focused entirely on implementing ServiceNow for their own clients. So the external distribution network is actually pushing the product for them, completely cementing their dominance. And this exceptionally sticky ecosystem, it is scaling into an absolutely massive arena. ServiceNow is operating in a rapidly expanding total addressable market that is projected to hit a mind-blowing $600 billion by 2028. This is not just about basic IT help desk ticketing anymore. This expansion is being driven by the convergence of workflow automation, agentic AI, and cybersecurity. In fact, through some major recent acquisitions like Armis Security and Veza Technologies, they've expanded their reach significantly. They aren't just detecting enterprise risks and logging them on a dashboard anymore, they're autonomously fixing those vulnerabilities directly through their automated workflows. It's a total game changer. Section 2. The Wall Street disconnect and the central conflict. So if the platform is so incredibly sticky, the revenue is that predictable, and the market opportunity is basically $600 billion, why the valuation collapse? Well, this brings us to the central conflict and the core fear that's gripping the market right now. Beyond just the aggressive macro rotation out of software, analysts have a very specific existential fear keeping them up at night. They are terrified that generative AI might destroy the traditional seat-based software licensing model forever.
Let's tackle this dynamic head-on. The bear case fear is complete disintermediation. The thought process is, if foundational large language models from companies like OpenAI or Anthropic get smart enough to automate complex data integrations directly on back-end databases, they could potentially bypass traditional software interfaces altogether. If an autonomous AI agent can just read a complex request and execute the work without a human ever needing to click through a ServiceNow dashboard, the fear is that ServiceNow loses its fundamental pricing power and its user seats vanish. But the bull case reality is entirely different. Instead of getting bypassed, ServiceNow is actively embedding those exact foundational AI models directly into their secure architecture. With their new Action Fabric and their omni-channel AI assistant called Otto, they are turning natural language requests into fully executed operations securely. They aren't fighting the AI wave. They are literally becoming the indispensable governance and execution layer for it.
Which brings us to Section 3, the Q2 earnings evidence, breaking down the July 22, 2026 results. So, which of these two narratives is actually playing out in the real world? To find out, we need to dig into the hard financial evidence. On July 22, 2026, ServiceNow announced its second quarter earnings. And honestly, this is the ultimate moment of truth to see if the core business is crumbling under AI pressure or if it's actively thriving. The numbers here are incredibly revealing, and they delivered significant beats across almost every key metric. Total revenue hit $3.987 billion. That's a really robust 24% year-over-year increase, easily beating Wall Street's consensus estimates. Then you have their current remaining performance obligations, or CRPO. This is a critical leading indicator because it measures contracted revenue that's going to be recognized over the next 12 months. That grew by a massive 21.5% in constant currency, beating their own guidance by 200 basis points. Non-GAAP EPS came in at 90 cents, which was another solid beat. Now, you will notice a GAAP EPS miss down at 29 cents a share, but context is absolutely crucial here. That miss was heavily driven by planned acquisition expenses as they closed the Armis security buyout. It was not a deterioration in the core software sales engine. But perhaps the most critical piece of evidence from this entire earnings report came directly from CFO Gina Mastantuono. She announced that their AI products just crossed a historic $1 billion annual contract value milestone during the quarter, and they are fully on track to exceed $1.5 billion by year-end. This is huge. It proves that this AI pivot isn't just some fluffy corporate speak on a pitch deck. It is a highly monetized, rapidly scaling reality. And enterprise customers are actively paying billions for it right now. And by the way, if you like deep evidence-based stock breakdowns exactly like this, make sure you're subscribed. Because all of the research behind this explainer was actually created using Flash by StockSentinel.ai. You can generate deep research reports like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free, but if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 different investor styles: long-term compounders, hidden gems, and dividend hunters. You also get Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code right there. Just scan it to download the Flash app and try it yourself, or access it on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's get back into it with Section 4, the qualitative scorecard, assessing true business quality. Beyond just looking at quarterly beats and misses, we need to systematically evaluate the actual underlying health of this business. So we're using a notebook-supported qualitative scorecard to measure these critical structural attributes on a scale of 1 to 10. Looking at these key metrics, ServiceNow achieves a blended score of 8.5 out of 10, categorizing it firmly as a wide moat compounder. And here's why. Their revenue quality gets a flawless 10 out of 10, purely because of that incredibly sticky 97% subscription base that basically never churns. Their market position is a formidable 9 out of 10, as they are the undisputed dominant system of action, sitting right on top of traditional systems of record. However, you'll notice the business viability score is sitting slightly lower at a 7 out of 10. That directly reflects that long-term existential risk we discussed earlier. The persistent threat of rapid technological disintermediation from generative AI and open-source models is real.
The platform is phenomenally strong today, for sure, but the tech landscape is shifting so fast, and moving from traditional user interfaces to AI agent workflows definitely carries genuine transitional risk.
Which brings us to Section 5, the 5-year scenario framework and financial projections. So how do all these qualitative strengths and technological risks actually translate into potential future shareholder value? Let's walk through our 5-year scenario framework. But before we dive into the numbers, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. But let's look at the operational math driving this outlook. Let's kick things off with the base case, which our research assigns a 55% probability. Operationally, this scenario assumes that ServiceNow successfully integrates its large early 2026 acquisitions and simply maintains its dominance as the primary system of action for global enterprises. Under these steady conditions, we're looking at subscription revenue growing at an 18% compound annual growth rate. With steady operating leverage, mostly driven by their own internal AI automation streamlining the back end, their free cash flow margin expands to a very healthy 36.5%. To value the business in year 5, we apply a conservative exit free cash flow multiple of 26x, which feels appropriate for a highly predictable recurring revenue model in a stabilized interest rate environment. So when you run that operational math, it yields an implied year 5 share price of $344.09. From the current baseline price of $124, you're looking at a 177% total return, or about a 22.6% annualized return. This is essentially what happens if they just maintain their current trajectory, integrate those new acquisitions smoothly, and hold their ground. Now, what if the bullish AI thesis plays out perfectly? In our high case, which carries a 25% probability, agentic AI offerings like their Otto assistant experience massive, rapid, enterprise-wide adoption. This immense value creation allows them to command premium consumption pricing instead of just flat seat licenses. Revenue growth reaccelerates to a 21% CAGR. Scale-driven efficiencies push the free cash flow margin up to an impressive 38%. With that influx of cash, they execute aggressive share buybacks to reduce the float, and the market ultimately rewards this dominant growth with a premium 32x exit multiple. In this high-case scenario, the math outputs a staggering year 5 implied share price of $515.32. That is a 33% annualized return. But we have to be entirely clear here. This case relies heavily on absolutely flawless execution of those share buybacks, heavy sustained AI monetization with zero margin decay, and a macro environment that is willing to pay a premium software multiple once again. It is definitely achievable, but it leaves absolutely zero room for error. On the flip side, we have to look at the low case, which we give a 20% probability. This is basically where the bear market fears become reality. Open-source AI agents begin successfully bypassing traditional software interfaces, which leads to real competitive disintermediation and a loss of pricing power. Revenue growth slows considerably down to a 12% CAGR. Higher AI compute costs end up compressing their free cash flow margin down to 33%, and due to the slower growth and competitive fears, the valuation multiple severely contracts to just 18x as investors rotate out of the space. Yet even in this decelerating, highly competitive, margin-compressed environment, the math still outputs a price of $154.20 in year 5. Because the recurring cash flow floor is so incredibly robust, even a severely compressed multiple and slowed growth still yields a positive 4.5% annualized return from current levels. The sheer stickiness of the platform literally prevents a total wipeout. And by the way, if you want to access the full model with all the detailed assumptions for every single one of these scenarios, you can check out the detailed research report over at flash.stocksentinel.ai. Section 6, the biggest hidden risks and threats to the thesis. Look, while the scenario math looks heavily skewed to the upside, no investment thesis is bulletproof. We need to pivot and talk about the most critical hidden risks that could actually break this thesis apart. Numbers look phenomenal on a spreadsheet, but real-world operational execution is where companies actually win or lose. The single biggest execution risk right now is what I'm calling the 2026 Acquisition Integration Challenge. In a very short time frame, ServiceNow spent billions acquiring Armis Security for $7.75 billion, Moveworks for $2.85 billion, and Veza Technologies for $1.2 billion. Historically, ServiceNow's ultimate competitive advantage has been its pristine, organically developed, single, unified codebase. Now they're staring down a monumental engineering and cultural challenge, simultaneously integrating 3 distinct, incredibly complex external technologies without breaking that core architecture. If this integration falters, we could see severe system inefficiencies, delayed product rollouts, and multi-year write-downs of acquisition-related goodwill that would absolutely crush the stock. And those massive acquisitions bring us to another critical risk hiding right on the balance sheet. To fund these buyouts, ServiceNow actually altered its historically debt-free capital structure. Long-term debt suddenly surged to over $5.4 billion. Now, while they currently generate more than enough free cash flow to service this, increased leverage is a fundamental structural shift. If macro conditions worsen, or if federal government spending freezes, which is a cyclical risk they are heavily exposed to, and free cash flow drops, that new debt burden could severely limit their flexibility to execute the share buybacks we were relying on in those higher return scenarios. So, what is the ultimate takeaway here? Wall Street has violently compressed ServiceNow's valuation multiple, pricing in a deep fear that foundational AI will eventually disrupt their seat-based software model. But the hard financial evidence shows a completely different operational reality. ServiceNow isn't being disrupted. They are orchestrating the disruption. They have successfully positioned themselves as the enterprise AI control tower, and they are already generating over $1 billion in active AI contract value to prove it. That is the profound pivot the market is missing. The key metric to watch next is their subscription gross margins. If they can maintain pristine profitability while integrating these massive security acquisitions, their compounding engine remains incredibly powerful. If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. The ultimate question for investors isn't whether AI will disrupt software, it's whether ServiceNow will be the one holding the remote control when it does. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.